Okay, folks, do a little bit of a review on some of the questions. Now, I'm not going to go through every single one of these posts because it's pretty much like a conversation between everyone amongst themselves pertaining to Model 5. And I answered some of the original questions, and other portions of the thread so far are just real quick, not to not to beat you up, but that's a lot of stuff going on this chart. I'm not sure what all this other stuff is, but either way, I'll answer this question here. Does the new day opening candle affect this model in any other way? And as like today, it went lower than up, as one could argue the presence of the power 3. But however, we were biased to look for price to go lower. How do we, if there's a method in determining the daily draws? Well, that goes back to the PD array matrix, which I'm going to bring up, which was omitted from the weekly commentary because you're supposed to be doing this to yourself. So I'm going to go to the second page of the posts, and this is like the heart of the discussion because it was more or less from this person's post here, Maddie. The question was, bring more clarity. When do we use the wicks? When are we using the bodies of the candles? And I'm going to make it very plain for you because I'm going to show you exactly what I did this past week that led to the cables analysis and then what you see in your charts today. So obviously you go through the whole thing here, making arguments about the wicks and then the bodies, and why am I showing examples of bodies and then I'm showing examples of wicks. And without going through all of the examples that you've posted, because you can now go back and apply what I'm going to show you in this actual teaching here. The good exchange here, by the way. And yes, this is my thinking exactly when it came to Maddie's post. Now, again, this is for your edification as a group, and I'm not trying to beat you up, Maddie. Okay, I get the frustration, I get it, but a lot of the things I'm going to talk about, if you've taken notes and you've paid attention to the teachings, this was all mentioned all throughout the mentorship, all those things. And as it relates to what do I use? Do I use the central bank dealers range? Do I use the flout? Do I use Asian range? Do I use the wicks? Do I use the bodies? I give you and gave you the context to when I use them. Okay, and I also mentioned that every single week I'm doing 2 charts. Every single time I'm using a plot on the wicks, and I'm also using a plot on the bodies of the candles relative to a 15-minute time frame, as you'll see in this example. Alright, so again, I just want to go through and just record all these because I don't want to have to answer these anymore or refer to them again, because again, most of it is just back and forth, which is fine. I mean, that's okay, but I don't want the threads to be filled up with a bunch of nonsense of, tit for tat. I don't want that. If we go through to the end here, again, Maddie's going on about the wicks and the body still. So that's really pretty much the point of this post. I'm going to bookend the video presentation I'm going to give you now as of this recording. And I'm going to thumbs this up only because I'm marking it as I recorded a recording that is going to address basically all the concerns that were made prior to this post. Okay, so I'm not thumbing it up to like the post. I'm not trying to be disrespectful either, but when I put a thumbs up, I'm using that like a bookmark. Okay, it tells me that I have seen your question, and now I've marked up to that point in terms of my responses. Okay, and let's go over to the charts. Okay, so we have our cable chart, British pound versus USD, and this is ahead of the commentary video that I shared with you guys on Monday. And this is what obviously the chart would look like, and this is what I was staring at before the fact, and I was dealing with this particular range here. Now obviously, going into the analysis, the first thing you want to do is ascertain where we are in terms of the market structure. Are we in a premium? Are we in a discount? Okay, so going back through the mentorship stuff, and everyone's forgetting all this, you're wanting to know, and Maddie, this is not, again, this is not a beat up session to you, because I'm still getting folks emailing me, I mean, pretty much straight questions, you know, tell me how to get the daily high. Tell me how to get the daily low. What am I supposed to do to get the daily high? And what am I supposed to do to get the daily low? It's a process of things that I've taught you so far in the mentorship, but you have to blend them as new days and daily ranges are created. You are always plotting the new standard deviations relative to the central bank dealers range, flout, and Asian range. Okay, there isn't this push a button, MT4 is going to spit it out, and there it is, I know it right away. It doesn't work like that. Okay, that's what some of you are actually asking for without saying it in so many words, but that's exactly what you're looking for. You want this to be real easy, push the button, cookie cutter every single time. This is what it is. And I've said that I don't always know that. Sometimes right away early in the week, like you saw last week, or this past week here, week ending August 3rd, 2018, I pretty much outlined the entire weekly high and explained to you in detail. But I'm going to give you the real nuts and bolts that went behind all that, because obviously, as I mentioned in the private teaching for you guys in the mentorship charter members, I have to keep the weekly commentary videos pretty much germane across the entire spectrum, and that way it forces everyone to use the tools that they are exposed to thus far in the mentorship. Whatever level they're at, they're being forced to use what I interpret as what the market may present for that particular week, and then use the tools that you've learned thus far and apply it. And again, you're not supposed to be trading during the mentorship, so not to say that you guys are in that group because you've already been through the 12 months, but a lot of the new members are doing what you had to go through. And I told you the same thing. Don't trade, but some of them are just trying to get in there and take trades. So if we go back through the mentorship and go through the whole process again, okay, and just like an overview, okay, the process I do, I have to look at the chart right now and determine what do I feel price is going to do. As I outlined in the commentary video, which I'm not going to revisit here, but you go back and watch them on these videos, all the buildup about why I think we're eventually pricing in an important low. You still have to trade the intraday volatility, okay? And given what's shown in the chart right here, I'm going to flesh out what it was that I was utilizing to give the analysis and commentary that I gave on Monday to everyone, okay? So right away, you want to determine where your premium and discount levels begin. And to save time, okay, what I was looking at and the way my eye goes to PD arrays and the range I was looking at. Now, yes, this is a 15-minute time frame, but again, the analysis was based on things that were shown on the long-term daily chart and certain conditions that I felt would materialize throughout the week. And again, go back and watch the video to build your entire understanding about what I'm showing you here. Okay. So we have the equilibrium price point. Okay. Anything above that is premium. Anything below that is discount. So right now we're in discount. So I was looking for a reason to see price trade up into this breaker. which is an hourly breaker. Okay. Now, if we blend this concept with the range aspect, okay, equilibrium starts right here. So for the breaker to be of any significance here on an hourly basis, which I'm not going to toggle to an hourly chart because, again, that was all shown to you in advanced teaching as well. But we have the bearish breaker here prior to this run up, clearing equal highs. My eye went to this area here. Okay, and once I put a fib just for equilibrium purposes and define my total range, I used a high to this low. Okay, that's this equilibrium price point. I also had this in mind, this high to that same low, and that's this equilibrium price point. Okay, you can see we've gone above it, we've gone above it again, and we've gone above it again right there. Now, does that seem indicative of a market that would utilize this range high to this low on Monday? No. And the reason why, we've already traded above equilibrium with this run here. We traded above equilibrium again on this run, and then we managed to go one more time above it. So is that giving you an indication, if you will, that this market is going to respect this range high to this range low? No, because it's having very little difficulty finding its way above the equilibrium price point, and every time it does it makes a higher high. Okay, ideal scenario would have been to see it trade above this high on here and then completely wash out the equal lows. And you're probably asking yourself, well, why didn't it go down below these equal lows, Michael? Why are you looking up here? Because of what I've shown you just now. Okay, when we have our ranges, we're looking at from the PD array matrix. We want to first determine, what is the market showing us? Is it showing a willingness to stay in a discount or stay in a premium? Okay, in this case, it's showing a willingness to want to leave the discount. So this equilibrium price point of, again, this high to this low, halfway between that is right here. So as we outline a PD array matrix, anything above the equilibrium price point is a premium. So it should find aggressive selling. If it's going to be a weak market structure, once it gets above that, there should be aggressive selling. Okay, not go above the equilibrium price point, sell off. Yes, that would be reasonable, but then it comes back above it. Does it sell off aggressively? No, it just meanders down, consolidates, and then runs above it again. So I completely negated this entire range here, okay, and elected to go back with what's the next parent price swing, this high to this low. And now our attention goes to this equilibrium price point right there. Okay, so I'm going to take this off, so that way our charts are focusing on primarily the things that are germane to what my analysis was on Monday. But that right there was exactly the reason why I was looking for price to get above this equilibrium price point. Now, obviously, you know the protocol then. What we're looking for above the equilibrium price point in the range is we're looking for all of the premium PD arrays. Okay, the ones I had in mind are shown here. Above the equilibrium price point, we have a liquidity pool here, right above this short-term high. Now, I didn't bother utilizing this as a bearish order block because if you look at what happened here, we have the long wick, and then we opened above the close of this candle, made a little bit more of a run up, left a fair value gap, which is noted, and we slammed down. In the next candle, we open up and trade into it here. So to me, that looks like it's kind of balanced out, and I didn't want to utilize that. So again, with the hourly breaker over here, I'm looking for a more deeper premium array. So I like the buy stop liquidity pool. Maybe we'll be watching that as the day goes forward. And now we have a fair value gap right in here. And then we also have the bearish order block. Okay, bearish order block low comes in at 131.74 right in here. That's what that's being shown here. And then we have the fair value gap, which is built on this candle here. Its low was 131.73, and the fair value gap is defined with a low of 131.69. Okay, so that's this candle here, this wick. So in between here, that's our fair value gap. Then above that, we would have buy stops here, and then we have the clean highs up here for a buy stop liquidity pool in the form of equal highs or Candyland. Alright, so now since we have that in mind, we have our 131.74 level with basically 2 PD arrays above equilibrium. Okay. Notice also that we have, with the buy stop liquidity pool here, the high comes in at 131.55. Okay, so 131.55. If we do a 10 pip grade sweep above that, it would be 131.65. 20 pips would take us to where? 131.75. Right in the same area as well. So now, Maddie, and anyone else that's struggling with how we're using the standard deviations for intraday volatility, i.e. the central bank dealers range, flout, and Asian range, the secret sauce is not to go in and try to play around with these levels to make them justify something. Okay? They have to be on your chart beforehand. Before you even consider plotting central bank dealers range, flout, or Asian range standard deviations, there has to be something in form of context. What I just shown you is the context. That's exactly what I gave everyone on Monday. But the folks that have not gone through the mentorship like you have, it went completely over their head. When they go back and watch that same video, after they get to a chart, remember, they have all the content that you've been exposed to, it'll make more sense to them. Much more sense to them than it did the first time. Okay. The only thing they heard was it's probably going to go up to the middle of the breaker here, and it might go into this area here and then sell off. Okay. They're only focusing on the fact that there's a fair value gap. But now the question is that overlaps with what you're asking in this Model 5 thread is, we went from which PD array do we use, Michael? Which one do I look for? To now forgetting that question, because the new soup of the day is, which standard deviation do I use? Or, coupling with the same theory, is which do I use, the wick or the body? Okay? You're going to have to submit to the things. When I tell you to focus here, you have to do that. Because if you don't do that, you're going to be making a big thing or a mountain out of a molehill. The context of what price is doing without all the lines and standard deviations and tools, that's what I'm teaching you. That's what the mentorship is. Understanding price delivery. Because if you don't know what that's going to be suggesting, like I outlined just right now, okay, I showed you why I didn't like this range from this high to this low. Remember the questions we were getting when we were doing live sessions and such during the actual mentorship, and you would ask, or some of you would ask, well, why did you not use this high to this low? Why are you using this high to this low? I just explained it to you relative to using the PD array matrix, which you learned later on in the mentorship, and that's the reason why I wasn't answering the questions like some of you wanted and some of the people that left. They figured I don't have an answer for it. There is an answer for it, but you have to be exposed to things over a long period of time, seeing things conceptually, modularly, and then they will start to dovetail together. Okay? These standard deviations that's a high order concept, folks. I mean, I'm not sure we're not plotting stochastics. Okay? And we're not plotting pivot points. Okay? It's not plug, play, and it's all there is to it. When people plot pivot points, it's pretty cut and dry. You know where your central pivot point is. You know your R1, R2, R3, and you have your S1, S2, and S3, and you have the midpoints in between. Pretty standard stuff. Simple, okay? But when you start really taking a step back and looking at it, then you start thinking, well, what am I supposed to do with that? Because sometimes the price will go through the R levels, and it should have acted as resistance because the context has not been considered. Retail doesn't know context. I'm teaching you context here, okay? We disregard this range here, and then our attention goes to this range here, okay? And then all the elements relative to how price was going above its equilibrium price point down here was suggesting that that was the level we're going to be reaching for, okay? So now, again, let me preface it before we take the next step forward. We are not, underscore, we are not going in and trying to get rectangles drawn on our charts, okay, and moving rectangles around and multiplying the projection of those and trying to find out where it matches up. That's not what we're doing, okay? People that are outside the mentorship, they're all trying to do that. And they'll show examples in hindsight where it worked for them, and it makes gives the impression to everyone else that they have now either cracked the code, the ICT code, or they know what the mentorship teaches, so therefore it's no reason to do it. Stay in the free tutorials. I'm going to show you today how all of those people outside of us are clueless. They can find it after it happened, and that's fine. And I used that as a pitch to get people to go into their charts and look for that. I encouraged it because I wanted to see if anybody else would see what I found. And they don't find it. They don't see it. So I'm going to show you now what I did. Since we have the equilibrium price point here for the range high and range low, we have a buy stop liquidity pool. 20 pips above that would take us to 131.75. By itself, that's enough. That is enough. But now couple it also with, we have a fair value gap that basically ends 1 pip short of 31.75 in the form of 131. Well, the fair value gap ends at 73, if I'm not mistaken. I think it's those. Yeah, 131.73. And then we have the bearish order block that begins at 31.74. Okay, so what's the high end range? 31.75. So that's how far price could stab to, above the equilibrium price point. Why did I say that? Because we have this candle here, which is the bearish order block. The low in that candle is 131.74. But above this candle's high at 131.55, 20 pips above that for a sweep above this high, again above the equilibrium. If it trades above it, how far should it go? 10, 20, 30 pips. Why am I not using 30 pips, Michael? Because we have all this confluence around 31.75 to 31.73. What is the number one characteristic that you have to consider when we use standard deviations for intraday volatility? When we have this, you're going to see a confluence around a PD array or PD arrays, plural, in a range of 5 pips. So there's a deviation that's allowed, okay, like a gray area. It can be plus or minus around 5 pips, not 10, not 15, not 7, 5 or less. Okay, that's reasonable. So now, what has my eye been drawn to, and what have I just made the case for? We have multiple PD arrays, all converging around 131.73 to 131.75. Okay, now, with that in our mind, right away, we've already did 90% of the legwork, and I didn't put a standard deviation up one time. I didn't plot any agent ranges. I didn't plot any central bank dealers range. I ain't worried about flout. None of that stuff even came into question yet. So do you see what I just did? I did all of the legwork and the analysis points with a clean chart based on premium and discount. Applied the PD array matrix. Where are my levels relative to that range? Why do I have to worry about going just to this one? Why not go any higher? Why not the buy stops here? Or why not run these equal highs up here, Michael? Well, think about it. If we are in a market that's probably going to go up and trade lower because the dollar might go higher. Let's just be honest. We might not see the seasonal tendency come into fruition. So if that's the case, we could see if price goes above this equilibrium price point, how far is it going to go? Well, I want to see where the tradable levels are around optimal trade entry. Whoops, we forgot about that. What's the range? High to low. Once and if we get above this equilibrium price point, is there something that overlaps and converges from a OTE standpoint? Well, let's take a look. Okay, so now what I have here, I have Friday's, not yesterday, I'm doing the recording on August 4th, 2018. Previous week's Friday, okay, on the 27th of July, we are looking at the measurements used for our standard central bank dealers range, flout, Asian range, those theories, okay? So we're looking at the elements of price action on a previous week to frame out potential expansions. We already had the range here, okay, from here to where Friday's close was. Well, not the close, but the low was before it closed for the week. So we have our consolidation in here, okay? Now, which do you use, the wicks or the bodies? You do both. The problem is you don't want to add another choice to your analysis because you're already making things harder than it has to be by overthinking. What did I already outline? There's a lot of activity in here from a PD array standpoint. It's in a deep premium if it gets to that price point. And also, look, think about what we have here. Optimal trade entry, 79% retracement, 62% retracement, 70.5 level. Of what range? That low to that high. So, in this area, okay, reaching back, in other words, looking back, all I'm doing is noting this here because I want to look at what it does on Monday, Tuesday, and Wednesday. So I'm keeping this in my mind as we go forward. Each day, I'm doing the standard deviations on each day. And I'm using the bodies of the candles for this model. Okay, you can see I'm using the bodies. Highest open or close here and here to the lowest open or close here. Okay, standard deviation. We have one that puts us up right in here. That closes the fair value gap. Also takes us right into that bearish order block. So that's one to watch there. And you would know that going forward during Friday. Once Friday's like trading it in London, it's already in the chart. We already know. So we just wait. Does it create a low and trade off the low on Friday? Okay, then we'll probably have to come back up here and fill in some of this area. Reverse it if it's been an up move on Friday, and we'll see what's going to happen on Monday. Does it want to show a willingness to want to come back up and close in these inefficiencies above a equilibrium, which would create a premium market? Reverse it for instances when the market has traded higher. We would look for the market to want to go down into a discount and fill in some inefficiencies there. But sticking to this example without trying to confuse you anymore, we have a standard deviation number 6 here that takes us up a little bit deeper in here. Doesn't really fit anything, but we also have standard deviation 7, which is above the 79% retracement level. Not to say that it can't stab there, but it just doesn't fit. In other words, I want to focus on our ranges, trading inside the range, using internal range liquidity. That's what we're trading off of. And we want to see a reason to anticipate price getting up to that level right in here. Okay, this would be plotted from a Friday. We close in the fair value gap, trade into the bearish order block as well. And then we go into Monday's trading using standard deviations, using the bodies of the candles. Okay, we have a standard deviation of 4, which is very, very close to this one here. And for completeness sake, this is $31.74. Not sure if you can see that. Yeah, $31.74. Okay. Well, that number seems pretty significant now, doesn't it? We have standard deviation, midpoint, right in here, lining up exactly with 31.74, which is the bottom of this bearish order block. 31.74. So all of a sudden, we have a confluence on Friday of the previous week. And it would be inside of the optimal trade entry range. Now, even though, don't be distracted or confused because I'm drawing it over here and not like here. I want to just remember, this is how I do my charts. Okay. And I try to keep these charts private because, number one, it's my analysis. I'm not trying to share everything that I do in my personal charts. Okay. Because you're going to want to do these things on your own and develop your routine with it. I'm not trying to create copycats of ICT. You're going to find ways where you feel comfortable with annotating your charts. Okay, and if it's something that makes it easier for you to understand, the worst thing that could happen for me as a mentor is show you what I like to do with my charts, and then you feel like it's superior than what you're doing already, and you're making progress at what you're doing. Okay, so I want to be aware and sensitive to the ability that I have as a mentor to screw you up too, and not really mean to do so. Okay, so the way you annotate your charts is going to be completely and utterly up to you, but this is how I've done mine. This is how my chart looks like each day of the week. So going forward, here's Monday's trading. Price trades up into, we had nice real sensitivity off of this level in here, here, and here. Beautiful delivery of price. And then on Tuesday, again, using the standard deviations with the highest opener close to the lowest opener close on the bodies. Okay, we have a standard deviation of 2. Now look at the close proximity we have here. Okay, very, very close to this one. If I put a line on it, it's probably going to say 31.75. And 31.74 still. And then ultimately, obviously, 31.74 was the quote high on the week. Right there. So we have standard deviation 2 trading on Tuesday that overlaps and converges with standard deviation 4 from Monday, which converges with the mid standard deviation here on Friday's data. Okay, so how many things how many things do you need to converge within 5 pips or less that is a PD array? See what I just did? I showed you the whole process as it's outlined in the mentorship, in the order that I gave it to you in the mentorship. There's nothing been hidden from you. I haven't shortchanged you. I haven't disguised something, calling it something else when it's really something this. Everything I taught you in the mentorship has been shown to you here just now. Okay? Now, this is what I elected to use because I'm going to go through and show you what the standard deviations were each day using the Wicks, and you'll see that there isn't any symmetry when I use that method. So you're going to have to go through the charts and use the Wicks and the bodies separately. So in other words, what I'm saying is you're going to have one chart that you work with all week long, that you're only plotting the standard deviations on a wick basis, whether you elect to use the central bank dealers range, whether you elect to use the flout, which if there's a premise over one or the other, I tend to use the flout. Okay, so if there's a question of which one supersedes, okay, or takes precedence over another, as long as we haven't made a range that would be greater than 40 pips, I tend to use the flout because I'm basically utilizing both central bank dealers range and the Asian range together. If we get gross exaggerations above that 40 pips, then I'm probably not going to be looking for a trade, or I'll just look for an opportunity to trade above the opening if I'm bearish, or buy below the opening if I'm bullish relative to the midnight candle. And that's how I would use it. So I just answered your question. Okay, go back through the thread and the things that you guys have been asking yourselves, which one do I do this, which one do I do that? I prefer to use the flout. In my own personal trading, that's what I like to use. And it gives me what you're seeing here. This like unbelievable precision. And you watched me do it beforehand. Everyone in the mentorship saw me explain in broad brush terms, but now you just got the backseat view riding with ICT. So you could see everything through my windshield as I saw it going into the week. And you can see the beautiful delivery here, price expanding up to 31.74 during the New York kill zone. That's the other thing. Okay. Show me how to pick the weekly high, Michael. Well, when does it usually form? Between Monday, Tuesday, or Wednesday. Well, did we get up to anything on Monday that we've already outlined a strong confluence around up in here? Now, if it would have traded up to this point here, probably Monday would have been the high of the week. But it didn't get there. Then we were already justifying why it was probably going to go higher anyway. So what's the day of the week going to create the high? Most likely Tuesday. Boom. You saw the execution shared on Twitter. Going into Wednesday, okay, we have standard deviation up to here. That is off a little bit. Let's see what the difference is. Okay, the line I have here, what's that level? It just popped up. 3142. So it can go 5 pips above this level, so it would be 3147, and the actual high comes in on this candle, 3145, less than 5 pips. That's reasonable, folks. Okay, that's reasonable. You don't get that anywhere, not even in the best of the best outside of ICT stuff. You just don't get that kind of precision. And then price starts to drop down, consolidates, okay, goes into Thursday's trading. But look at the standard deviations that are plotted on Monday, Tuesday, and Wednesday. Okay, this is your takeaway for this lesson. Not only did I answer your questions and show you what was behind the scenes and why I elected to use the bodies of the candles this week, and not Wicks. And again, I haven't forgot, I'm going to show you the contrast with the Wicks. But when you plot the levels on your Monday, your Tuesday, and your Wednesday, you have to leave them on the rest of the week. Okay? Look for price to reach down into a discount array that has multiple things, converging around it as a confluence of events that occur at a standard deviation. Okay? So what we're saying is this is going to be a turning point or a swing high. So we have the highest high on Tuesday, lower high on Monday, and lower high on Wednesday. So we're looking for expansion on the downside. So what do we reach for? Some standard deviation going down. Do we need to plot it on Thursday and Friday? No. Because all the work's already going to be done by the algo by Wednesday. Oh, you just learned something, didn't you? So now you don't have to worry about doing standard deviations on Thursday or Friday. Friday for the purpose of using next week's trading. But if you want to get really ridiculous with your precision, you want to be day trading on Thursday, then obviously it goes without saying you can put your standard deviations on for Thursday's trading if you're going to be day trading. Not necessary for one shot, one kill. Okay, so let's scroll forward a little bit more. And price goes down to a mid-level standard deviation. Perfect delivery to the weekly low. Okay, if we go back with this price level here, this low comes in at 29.77. 29.77 is $29.77 right there. What's this candle here? I'm going to zoom in. What's this candle? Obviously it's an order block, but what kind of order block is it? Propulsion candle. Remember the rules of the propulsion candle. A propulsion candle is going to be a bullish order block. In this case, it's everything I'm about to say is reversed for bearish propulsion candles. But we have an order block here that's validated with a candle that trades through it. And then we open, trade higher, and then we dip down. Propulsion candles must not trade below the mean threshold of the original order block it trades into. In other words, so we have an order block, we trade back into it here. It doesn't go to the mean threshold, so this is a qualified propulsion candle. This is the candle you draw your level to, not this one. Okay? Go back to the mentorship and really go. I mean, I told you it's a lot of stuff, folks. It's a lot. It's going to take you years to get all these things into a plan that you will stick to and not have to feel like you're tweaking all the time. But if you don't understand the PD array matrix and the way we go through the cycling through of how they go in order and going back through them, the standard deviations are going to be no use to you. They're just going to be a point of confusion, if you will. Okay, and you're going to be feeling like it's form-fitted or it's cherry-picked, but you can't argue with this. I already gave it to you before it happened. I'm reading reviews on Forex Peace Army, and there's somebody on there saying they're in the mentorship and they're displeased because I don't show examples of this stuff. Where you been, man? I've been doing it for weeks. So you can't deny this. You cannot deny it. I didn't give you something outside the mentorship to justify, oh, I'm showing you something here, and it's really something else. That's not true at all. What I just showed you is exactly what goes on. There's the entire range right there, zoomed out. So the fractal is this whole big upswing, and it finally breaks back down right into the propulsion candle. Now, can it roll over going into next week? Sure. But you have to use confluences to reach these price levels. When did it get down to that level here? What's the time on this candle here? What is that? It's London Open. Ain't that a significant time of the day? If it trades down to a deep discount array at a key level, at a key time of the day, at the end of the week, should you expect some kind of reaction there? Sure. So let's go and go back over here. Okay. And I'm going to change it to Wicks. Okay. Same premise, optimal trade entry. So I'm going to take this off because it's going to not line up as I scroll through, and that's just going to drive me nuts. So now we're using the wicks, not the bodies. Okay. Up in here, the only standard deviation we have in that same PD array that we've already agreed at before we even considered standard deviations, we have the gap in here. So this one here. Then we have a standard deviation that agrees closely with that one, but we lose it here. It drops down more than 5 pips. Right away, does it tell you to stick with wicks or use the bodies? Remember, you're plotting these over here before we get past midnight on Tuesday. So right away on Tuesday, what did I tell you in the mentorship? I wake up around 11:30, sometimes to 12:30, depending upon what happened that night. What am I looking for? What I just showed you. I just explained it to you, folks. That's what I'm doing. I look for that element right there. Should I be focusing on the wicks? Should I be focusing on the bodies? If there is a breakdown, here's something that's good. It's inside. I'm sorry, this one here. This is inside the gap, so that might be good. We get one that's in close proximity, so that's a good level. And there's nothing on this day here. The standard deviation 1 is down here, and the next mid-grade is up there. So, is there symmetry using the wicks? No. So what do you use, Maddie? Whichever one shows the symmetry that agrees with a PD array that you already liked in your naked analysis. It takes work. You're not going to have a push a button, an MT4 indicator is going to highlight it for you. It doesn't work like that. I'm telling you, it's going to require you all to work. There's a lot of things that are going on. And believe me, I look at all this stuff and how I arrived at all this stuff. If I wasn't a programmer, I never would have got this. I never would have gotten it. But I looked at it from, if I was going to engineer something and develop it as a systems analyst, how could I create an algorithm that would do this? That's what made sense to me. And then I started seeing it like this. So, that's your answer, Maddie. And anyone else that's wondering, what do you do? What's the process, Michael? What do you do each day? How do I get the weekly high? How do I get the weekly low? This is how I do it. Everything I explained to you in this video is worth the mentorship 3 times over, just in this video alone. I could do seminars just teaching just this and turn people into ridiculous traders if they submit to what I just explained. But they're going to overthink things. They're going to want to bring in Trader's Trinity. They're going to want to look at Power 3 every single day or misappropriate things, and you're getting in your own way. You have to listen to the things I taught you and use them in the context I taught you and use the rules that's been applied. It's just that simple. Over time, how long? I don't know. Some of you already have it. Some of you are still struggling. If you're struggling, you're not alone. Okay? There's a couple dozen of you still that are just spinning your wheels. You haven't figured out what you want to do because you're wanting push a button and get the answers. Okay? And I don't mean that to be derogatory. I'm not trying to belittle you. I'm not saying you haven't worked for it. Okay? Every one of you have worked for it. If you've gone this far, you're working. And I get it. But remember, it took me 6 years to get what I just gave you here today, with no one helping me. Where do you think that you're going to get it any faster? You still have to grow into these ideas. So don't be discouraged. Don't freak out. Okay? I'm still walking you through the market every single week. So you're getting a little bit of a nudge. But I'm not providing signals because some of you guys are doing signal services right now, and I'm not going to lace your pockets with that. I'll put you in the right direction, and that to me is enough. But you all know how to do these things if you go through the material and you study and you study and you study. Do the things I told you to do. Every single week, every single day, you put your charts together like this. And it teaches you over time. You should all have a huge study journal loaded with these types of examples. It should be fascinating for you to go through and see price action like this. I mean, think about it. Now, let me add this real quick. On this particular day here, look at the delivery only on this one day. Okay, on this Wednesday, we have the Wicks being used. Okay, look at the delivery here. That's perfect. Look at the delivery here. That's perfect. Scrolling forward. Perfect. See that? So there's going to be times where if you don't look at both of them, you're going to miss it. Why did the Wicks work here and not the bodies? Remember the bodies were showing you this level here? What took place? Now, think about what I'm about to tell you because you're still pissed off about what I just said, and I probably hurt somebody's feelings. Stop for a second. Take a deep breath. Exhale. This is a big milestone now. The market's already turned back here, but it was engineered on what format? The bodies of the candles. So now what's going to happen? It's going to expand. When we look for expansions or we look for ranges, what do we look for? The bodies or the wicks? The wicks. Now we get precision. Here, here, here. So please, don't get emotional on Twitter. Don't get emotional in the forum. When you write down things, Maddie, and say that you're frustrated, I get it. You don't need to communicate it to me. I look at every question to me as a frustrated student. You don't need to exasperate it, okay? Because when you do it, you're putting it in writing. And not only are you keying yourself up, okay, but you're mentally and subconsciously reinforcing the idea that you're stuck. And your mind's going to stick to that. Every time that you have a learning experience or opportunity to learn, you're going to feel, not getting this, falling short of the mark, frustrated. You said it yourself, you don't feel that you're an idiot, and no one is implying that you are. This is highly technical stuff. Highly technical. And believe me, I have people that took engineering, and this goes over their head many times. They're like, how did you figure this stuff out? Believe me, if it hadn't been for God, and I don't care if you believe that or not, I believe it. There's no other way for me to justify how I can learn this, okay? Because no one else teaches it. The guys that are market makers, okay, they don't do what I'm showing you. They don't have charts like this. What I did was I bridged the concepts of manipulation they use, and I found signatures and price action that replicate, that show me what they're doing, and many times before they even do it. How else are you going to justify what was shown to you this week? Think about it. Far more than Baby Pip's optimal trade entry. So many more things. And you should be excited because once you grasp this, I take the precision even further than this. We have so much learning ahead. So don't feel like you're in a rush. You're never going to catch up to where I am. Okay, you're not going to do that. I'm 20 plus years ahead of you. Take the journey and just relax. You all have so many things to learn, but you have to allow yourself to grow into the things that you've been exposed to. Don't get emotional. There's no reason to get emotional. I haven't walked away from you. You know, I've seen on the forum, they say that the forums are dead. They're not dead. You guys are asking questions, and when it's appropriate, I'll give responses. But look at the thread here. There wasn't really a whole lot of questions except for Maddie. He provided the context for this lesson. When there is significant questions that are, I guess, in my opinion as a teacher, okay, it's noteworthy for me to go in and change a direction with my approach to make it a little bit deeper. Okay, and hopefully I've communicated that, at least with this topic, with this video. But there's a lot of times I read questions in the forum, and they're questions that are so generic and, well, not really, generic's not the right word. They're so cringy. Okay, and if I'm making you upset, and if this is one of your questions you never felt like it was answered, I want you to understand the reason why I haven't answered it. Because these are some of the things that are so obvious, and we talked about it nauseum in the mentorship. To me, it communicates the person was either watching TV, doing things, playing video games or whatever, really not paying attention. Okay, because a lot of the questions that were asked in the mentorship posts, post mentorship, they're questions that were answered, not in just one spot in the mentorship, really. So when another member steps forward and says, go back and look at something else that was already shown in the mentorship, they're not really being, I guess, rude. Okay, I guess in a way you could say what I just said here could be viewed as rude, but I wouldn't take it as being rude. If I was the student, I'd be like, okay, my instructor just said I shouldn't be asking these types of questions because I obviously wasn't paying attention in the mentorship. And guess what, folks? There's a lot of content, and you don't know it. Go back and watch it again. That's why we're light volume right now. I gave you so much stuff. You're supposed to be reviewing it. How many times have you gone through the mentorship again? I told you, write down the areas when you go through each one of these monthly modules, when we were going through it live, write down the sticking points that you're going to have, okay, and at the end of the mentorship, then you're going to want to go back and spend time in that. There's only been one person that's come to me post-mentorship and said, I went back and looked at it and it filled in all the gaps for me. But I have 5 or 6 people asking the same questions that are answered in multiple places in the mentorship. For me as a mentor, that frustrates me because I have already provided those answers and not in one place. But I guarantee you these are the same people that did not take a great deal of notes. They probably scratched a couple little things here and there or worked out the PDFs if they've even printed them out at all. And you get what you put into it. There's other people here that have gone through the mentorship and they are killing it. They're doing so much better than I had hoped. But there's others that are just haven't found their way yet. You are going to get there. There's so many more tools and approaches, and one of the things that I mentioned I was going to do in August is we're going to be doing another specific teaching session on how to literally build a ground-up model for 6% a month. And because that's what I teach. I teach that in the beginning of all my free tutorials, that should be a goal. Okay? And I'm going to literally sit down and build out a complete trading plan. Now, when I say complete, I'm saying, what do I do each day? What am I doing to facilitate that? Okay? What filters am I going to use? What am I going to be trading to get that? Is it going to be, what model components am I using? Okay? That's the only real model I'm going to build up from the ground up. Okay? And the reason why is because I'm giving you ideas post-mentorship to plug and play certain components, because you've been introduced to many of my concepts, but That's nothing compared to what's coming. And if you don't find your footing right now in 2018, you're still going to be spinning your wheels in 2019 when I start putting out new content. That's higher order price delivery. And you're just going to stay in a state of perpetual confusion because you're going to feel like, man, I can't keep up with this guy. And just prepare yourself for it because it's going to be a lot more stuff. So your work right now is to figure out what you want to be focusing on. It doesn't mean get in there trading, okay? It doesn't mean that. It means finding out what you want to focus on as a trader. Are you a day trader? Are you a short-term trader? Or are you a swing trader? And that's the other thing about Forex Peace Army. I never teach anything about swing trading. Go back and look at the daily charts and the weekly commentary. I'm telling you where the market's going to go. Why aren't you participating in swing trades? Why aren't you participating in it and putting it on the forum where other people can see it? Put yourself out there. Do it. That's how you learn how to do it. I don't need to prove that I know how to do this stuff. You guys are the ones that are trying to learn it. And the way you learn it is you put yourself out there. Do you desensitize yourself by going onto the forum and saying, this is what I think is going to happen? No one's going to ridicule you here. If they do, I'll slap them. This is not the place for that. But by doing that, you're going amongst your peers and you're putting it out there and you're going to see what happens. And you're going to have to watch it when it comes to fruition or when it fails. And you're going to know that everyone else is watching you. When you do things like that, it forces a greater depth of appreciation in the marketplace and it makes you pay attention. There is no laziness when it's exposed like that. Believe me, you're caring about every little pip. And by doing that week after week after week, you know what happens is you desensitize yourself to feeling you have to be right. Because you're focusing on what? The process. You're paying attention to the details. Now, you're hoping that the outcome is going to be in your favor, but it is more specific and directly related to, are you doing everything that the mentorship taught you? Because whether your trade pans out or not, that's not what you're fearful of. You're fearful of the guy that comes up and says, that's not what you were taught in the mentorship. See? That's why I encouraged you guys to do this during the mentorship. But it wasn't widely accepted because you all want to feel safe inside your little bubble. And you're not going to grow as a trader safe inside your bubble. You got to get out here. You got to get hurt. You got to get the thorns stuck in you going through the bushes. You got to be out here and crawling around with this stuff with me. Every week, I'm putting my neck out there and I'm telling you what I think is going to happen. You tell me if I'm not giving it to you the way it's supposed to be taking place. It's happening as far as I'm concerned. And we think we had like 2 weeks out of the last year or so post-mentorship where it didn't really pan out. But for the most part, it's panning out. And you've had plenty of reasons and analysis to justify swing trades, Mr. Joe Schmo. Okay, so anybody in the mentorship that made that post on Forex Peace Army with the low review, I don't care about that review. Okay, I don't care about it. Because I have so many people coming to me every single day with emails telling me they're getting it, they're seeing it, and they're getting value. Okay, I take this as you didn't give me the spoon-fed trades. Because I'm showing you what the market's doing on all aspects. Swing trading, I'm telling you where it's going to go longer term on the daily chart. That's the invitation for you to go in and use the things that you learned for swing trading. And engage. I'm not a signal service. You knew that coming in. Short-term trades, every single week. You know it. I'm telling you what I think is going to happen. Day trades, fill in the gaps. Use Power 3 inside of the range expansions that we outlined in the commentary. Every single week, every component of the way the mentorship was taught to you. Scalping, day trading, short-term trading, one shot, one kill, swing trading, position trading. That's all been covered. For months, we've been talking about what the dollar is going to be most likely doing and the foreign currencies as a result. I told you what was going to happen in the E-mini S&P. Month of July. It's going to be bullish. Is that a day trade? Mm-mm. One shot, one kill? Nope. Swing? Yep. Look at the E-mini S&P right now. What are you waiting for? I'm not going to put you in a trade. I'm not going to do that. I'm pointing to where the opportunities are. And how many are you letting go by? I'm not going to get in here and dress up a chart and say, buy here, sell here, stop here. I'm not doing that. I didn't promise that. I promised that I would show you how to do it, and then I'd point the way, and you tell me what you did. That was the agreement.